And Rebecca Walser's with us, President Walser Wealth Management. Thank you for being here.
Thanks, Nicole.
So we had Fed Day yesterday, and then the market really sold off.
Yeah.
I mean, the worst sell-off for the NASDAQ, for example, since October. Trying to give it a go a little bit today, different story today. What were your thoughts?
Yeah, I completely expected it. I mean, obviously, no one was talking really about a January cut, but certainly what we did see, Nicole, is that Fed Watch went from 55% for a March cut to 46%. So the market was basically, again, ahead of its skis, trying to push the Fed for earlier, and the Fed is saying, look, no. And Nicole, when we stop and we think about it, we're so in micro at the daily basis, quarterly basis, that we need to stop and think at the big picture. Governor Christopher Waller, last month basically said, these are not the conditions under which we normally cut. Right. We don't have strong fourth quarter GDP on an annualized basis. We don't have labor still strong and going up. We don't have, so what are the reasons that the Fed would cut? Obviously, the Fed would cut, Nicole, because the cost of capital is way too high as compared to the last 15 years. Right. But the economic conditions are not yet showing up on the tape to say we need to cut, and the market doesn't like that.
And do you expect one maybe in June or the back half of the year?
I mean, I think that certainly May is absolutely on the radar. I think that's still at a 92% on Fed Watch. And so I think May is probably more realistic. It's certainly, if we get a strong labor report tomorrow, it's going to put Powell again in a much more difficult position to really cut in March.
Yeah, understood. So how did you think about the market reaction? I mean, the idea is as goes January, so goes the year. And particularly in an election year, we did have a winning January, but there was a pretty decent-sized sell-off yesterday. What do you make of the market? What are you anticipating for stocks?
I think that tech is also part of that problem, that equation, right? You see a lot of AI pushing the Mag 7 last year, and then we look at Google, and we look at, Google is Alphabet, and we look at, so we're having issues. Microsoft is the other one I was looking for. Microsoft and Google both coming in with earnings and saying AI is not quite delivering what the investor is expecting. It's going to take a little bit more time. Obviously, Apple, worst performing of the Mag 7 last year, still over 50% growth. But the good thing about Apple reporting on after earnings today, Nicole, is they aren't so AI focused yet. That's still kind of what they're coming up to, and so we maybe will have less impact from AI on Apple. But obviously, we have the whole China issue, and we have a lot of other issues with Apple that is making them sort of having some struggles. So I think the market has wanted to push this Fed for what the market wants. The market wants, monetary theory, constant stimulus, constant pushing in, and we are a consumption economy, and that's kind of what we need, Nicole, to see the growth that's expected and the projections and these earnings that are expected. But obviously, a lot of earnings are getting tapped down for expectations, especially on the AI front, and so I think that's going to be a different Mag 7 story this year.
And jobs. I mean, we're getting a news on jobs, and I'm getting some mixed reports because it seems like the job market is still pretty tight. At the same time, we've still seen a lot of layoffs in tech and finance. So any thoughts on the jobs picture? Yeah,
what we're starting to see is a softening, and we're starting to see those that are wage earners that are changing jobs are not getting as high of a percentage of an increase on the change that we were seeing last year. So I do think that the labor story is going to be different in 2024. And of course, if we continue to see softness in areas and there's continuing layoffs, then this again will help Powell, come out and be a lot more accommodative. But the market is expecting the Fed to pivot and to cut and to be a lot more accommodative before the actual economic indicators are there. And if we look at Bank of England yesterday, obviously, they also are holding and pushing potential expectations for a cut further back too. So all the central banks are kind of doing the same thing. We're still going to cut. Don't think we're not, but it might be a little bit later.
So what do you tell an investor? I know you have some concern about some of the banks after what we saw from New York Community Bank, which is down again today.
Absolutely.
What do you tell investors where to put some money to work?
Well, you have to find this is a tough one, Nicole, because you really, especially when the market's at its top. It's not the traditional advice to buy in at the top. We don't usually buy in. So now we have to really be specific and targeted and find the opportunities of the undervalued or the stories that haven't yet been mainstream picked up so that you can really find a win. Otherwise, I think you're going to look at commodities for safety if we start to get really choppy this year, which we're sort of expecting 2024 with the election, Nicole. Things things should be expected to come as market disruptors, whether it's the border crisis and the constitutional kind of crisis that America is facing, whether it's something at the Olympics, whether it's an escalation in the Middle East and the Red Sea, whatever it is, the market needs to really anticipate some crazy stuff this year.